Howdy, Jacob here. Today we're looking at BYD Company. From what I've heard about them, they are the Tesla of China. And I mean, from what I'm seeing right here, looks pretty accurate. Revenue growth, absolutely phenomenal in the automobile industry. Balance sheet has 16 billion cash on hand, 2.5 billion short-term debt, 1.7 billion long-term debt. Very safe balance sheet, especially for an automobile maker. I've listened to talks with Mohnish Pabrai, and he has said that their CEO Wang Chungfu, the CEO of BYD, is the Elon Musk mindset of the China EV market, where they're just absolutely insane. Um, he's a fantastic CEO, and I mean the figures right here show absolutely incredible growth from 9.4 billion in revenue in 2014 to 84 billion in 2023, nearly 10 times. I mean that is astronomical. Similar to other automobile industry markets, gross margin not so fantastic, operating margin not so fantastic, but increasing. So that's a great sign. They pay a dividend, weirdly enough. That's kind of surprising, but earnings per share, immense growth. Return on invested capital recently over double digits, which is positive, but historically, I mean, maybe they've just been heavily growing, or maybe they've been spending to heavily grow, and that's going to affect your return on invested capital figure, since the net operating profit is going to be the numerator portion of that. So they've been really heavily investing in R&D. You have 20 times R&D expenditures in the rolling 12 compared to 2014, the full year. 301 million investment to 6.1 billion. I mean, they are investing for future growth, future margins, future perspective, and I mean, yeah, that's a positive sign. They Shares relatively flat the last couple of years, pretty solid there. We already saw the balance sheet, looked amazing. Free cash flow statement, huge capex spending. They're just spending a whole bunch on reinvestment for future growth. So this will be another fairly tough analysis, as their margins right now are smaller. But again, the more you spend on R&D now, it's hopefully for growth and better margins down the line. And so this should be an interesting analysis here. So on the revenue growth side, I mean, they're already at $84 billion in revenue. They engage in automobiles, batteries business, okay, mobile handset components, assembly services, and other products. I mean, 10% a year, maybe I'm way downplaying this. I mean, I guess it is also in China, so I got to give a little bit of a PE depreciation there. But margins, free cash flow being so much higher, I absolutely adore that. Let's do 6, 8. Um, Dividends currently paying out on a yield basis, or a percentage of capital allocation, 544 million in total versus, that's less than 10% of capital allocation. What have they been increasing this in the past? All over the place. So let's keep that the same. Let's say that for share changes, they haven't been buying back really shares. So let's just say 80% goes to acquisitions or reinvesting back into yourselves. I think that seems pretty reasonable to me. And based on this assumption, based on all these assumptions, we're saying that the company stock price needs to fall 10%. I mean, to me, automobile industry is always tough. Can they get these types of margins? I don't know. That might be a stretch. Is this revenue growth number too conservative? Definitely, possibly. And I mean, if they're able to continue growing at 30% a year, I mean, that's just astronomical. And so there's going to be a time where it slows down. But again, they are in the second most populated country in the world. So I mean, maybe if the revenue growth, or if the growth and income of the individuals is pretty substantial, well above the price of inflation that it's going to cost for these automobiles. Maybe you have a lot more automobile purchases. So I don't know. This is an interesting company, and I've heard great things. Obviously, when it comes to China, people have their perspective on that. You can't just take into consideration the country, but also the geopolitical risks that come with that, and balance it out from your perspective. What my position is going to be different than your position, and so if you just entirely block off all the Chinese companies, that's totally understandable. If you don't feel comfortable in understanding those risks, then absolutely. But I think everything to me can be purchased with the right margin of safety. I mean, even if I just need to be entirely confident in the numbers and entirely confident in my assumptions with that extra margin of safety for me to be, for me to make a reasonable assumption. And so for me right now, we're looking pretty close. So I might have to do more research here. I hope you enjoy the video and have a great rest of your day. Thank you.